Okay, so let us now resume our recording on absorption costing versus variable costing. Okay, so this is the second part, 2 of 2. For this exercise, we already began the discussion on this one. We answered item number 1. Determine the number of units in the ending finished goods inventory. And the answer would be 30,000 units, calculated as 200,000 production, no beginning inventory, minus 170,000 in sales, that's 30,000. The 30,000 units under variable costing would be valued only at 18 pesos. Variable manufacturing cost is at 18. So 18 times 30,000 is 540,000 pesos. But under absorption costing, the fixed manufacturing overhead would also be included as product cost. 840K divided by 200,000 is 4.20 rather. So 840,000 over 200,000 is 4.20. 4.20 plus 18 is 22.20. That would give you 30,000 times 22.20, 666,000. This time we're going to answer number 3, then number 4. This time, I'm going to show the correct format for variable costing. Again, the format that we will use is contribution margin approach. Under this approach, we are going to use as a basis for classifying cost the behavior. Sales revenue minus variable cost is contribution margin, minus fixed cost, operating profit. Okay? So let us start with variable costing. Sales revenue, 170,000 times 48. You would have 8,160,000. Again, that's 8,160,000. Your price times the sales units volume. Deduct the cost of goods sold, variable portion, 18 times 170,000, to be followed by the selling and admin cost, variable portion, 7 times 170,000. So the total variable cost would be cost of goods sold variable, 18. Selling and admin expense variable, 7, that's 25. Okay, 18 plus 7 is 25 times 170,000. Your variable cost, that is the rightful light item to be deducted from sales revenue under variable costing, is 4,250,000. The difference between sales and variable cost is contribution margin. In this case, 8,160 minus 4,250K is 3,910,000. So again, this is the correct format in preparing the contribution margin income statement. Instead of deducting cost of goods sold, we would deduct all variable cost to arrive at the contribution margin. This is to be followed by all the fixed cost. Your fixed manuf cost is 840K. Fixed selling and admin is 925K for a total of 1,765,000. So 3,910K minus 1,765K. That would give you an operating profit of 2,145,000. That is the answer for number 3. 2,145,000. As for absorption costing, we're going to start with the same revenue. Sales revenue is 8,160K. Instead of deducting all variable costs, we will deduct all the cost of goods sold. Again, that would be 18 plus 420, 22.2. 22.2 plus 22.2 times the number of units sold, 170,000. Your cost of goods sold is 3,774,000. Again, the cost of goods sold is 3,774,000. This would give you a gross profit of 4,386,000. Then the next item for deduction are the selling and admin expenses. Variable selling admin is 7 times 170K. Then the fixed selling and admin is 925K. 1,190K plus 925K is 2,115,000. Okay? 2,115,000 to be deducted from 4,386K. Your operating profit will be 2,271,000 under absorption costing. Okay? 2,271,000. You can actually reconcile these two profit figures by taking the difference between production and sales, which is 30,000, and multiplying it by the FOH rate of 4.2. 4.2 times 30,000, that's equal to the difference between the variable costing income and absorption costing income. So these are the answers for this problem. So before we go to the last problem of the handout, I would like you to answer this one. Okay? So additional problem, you are to prepare absorption costing income statements for years 1, 2, and 3 to be followed by variable costing years 1, 2, and 3. So absorption costing muna, I will give you 5 minutes. No? A total of 5 minutes to prepare the absorption costing income statement for years 1, 2, and 3. Go. Okay, so let us now resume. Again, you just need to answer the portion pertaining to absorption costing first, and then to follow the rest. ABC company manufactures metal cans used in the food processing industry. A case of cans sells for 25 pesos. The variable cost of production for one case of cans are as follows. Variable selling and admin costs amount to 0.50 per case. Budgeted fixed manuf overhead is 400,000 per year. Fixed selling and admin costs is 37,500 per year. The following data pertain to the company's first 3 years of operations. So take note that planned production and actual production are still the same. So planned production and actual production for the 3 years are always 80,000. Okay? So no variance would exist. However, when you look at the sales vary year to year. Year 1, it's 80K. Year 2, it's 60K. Year 3, it's 90K. Okay. So we are to prepare absorption costing, income statements for years 1, 2, and 3. So the selling price is 25. Year 1, 80K. Year 2, 60K. Year 3, 90K. So let us first calculate the fixed overhead per unit. So magkano ba ang fixed overhead per unit? It's 400,000. And throughout the 3 years, it will always be 80,000 per year. No? So 400,000 divided by 80,000 per year, that would be $5 per unit. So there you go. Under absorption costing, you would have a cost of goods sold per unit of 16 plus 5, 21 pesos per unit. No? So the price is 25. The cost of goods sold per unit is 21. No? Then the variable selling expenses is 0.5. The fixed selling and admin is 37,500 per year. So year 1, sales units 80K. Year 2, 60K. Year 3, 90K. So let's start. In preparing absorption costing income statements, in year 1, we will have 25 times 80,000, 2 million. Year 2, 25 times 90,000, 1.5 million. Sorry, 60,000 rather. 25 times 60,000 in year 2, 1.5 million. And then in year 3, 25 times 90,000, 2,250,000. When it comes to the cost of goods sold, as calculated, it's 21 per unit. Year 1, 21 times 80K, 1680K. Year 2, 21 times 60K, 1260K. Year 3, 21 times 90K, 1890K. Revenues minus COGS is gross profit. In year 1, the gross profit is 320,000. Year 2, 240,000. And year 3, 360,000. The selling expenses would include 0.50 per unit only. So 0.50 times 80K, 40K. 0.50 times 60K is 30K. 0.50 times 90K is 45K. And then don't forget your fixed selling expenses. Your fixed selling and admin is 37,500 every year. So you would arrive at the following operating profits for the years 1, 2, and 3. Operating income in year 1, 242,500. Year 2, 172,500. Year 3, 277,500. Okay? So a distinguishing feature of absorption costing when compared to variable costing is that the cost of goods sold incorporates the FOH. So the fixed overhead expense during the years were based on the units sold, not based on the actual FOH incurred. Okay? So these are your operating income figures for years 1, 2, and 3. Ayan na ha. Ito yung itsura dapat ng income statement pagdating sa absorption costing. Okay? Let us now do the next requirement. This time we are to use variable costing. This time we are to use variable costing. Same given, go. Okay, so just pause this video in case you have not completed your requirement first. Okay, variable costing na, no? Variable costing. This time under variable costing, the variable cost will be deducted first. Ito na yung tamang format ha. Sales minus variable cost is contribution margin. So that's a total of 16 plus 0.5 per case. 1650 per case. That is your variable costing. That is your variable cost, no? 16 plus 0.5, that's 1650 per case. And then the fixed overhead together with the fixed selling and admin will be expensed when they are actually incurred. Okay? So under variable costing, your sales revenue are still the same. 25 times the number of units sold. So you would have for year 1, 25 times 80K. Year 2, 25 times 60K. Year 3, 25 times 90K. The line item for deduction would be your variable manufacturing cost, aka cost of goods sold, 16 per unit. 16 times 80K, 1 to 80K. 16 times 60K, 960K. And 16 times 90K, 1 for 40K. And then your variable operating expenses, 0.5, no? Forgot to put here. 0.5 times 80K is 40K. 0.5 times 60K is 30K. 0.5 times 90K is 45K. So you now have your contribution margin after deducting the variable cost from the revenues. They are 680,000 in year 1, 510,000 in year 2, 765,000 in year 3. Then we are going to deduct all the fixed costs, the fixed man-off overhead of 400,000 per year. Then you have the fixed operating expenses, 37,500 per year. So the operating income in year 1 would be 242,500. So this is the same under absorption costing. Year 2, the variable costing income is only 72,500. In year 3, it is 327,500. Note that since production and sales are the same in year 1, your absorption costing income and variable costing income are the same during that year. In year 2, the absorption costing income is greater than that of the variable costing income. This is due to the fact that production exceeded sales. So, in absorption costing, the portion of the fixed manufacturing overhead that is not yet sold will form part of inventory. So the amount expensed in COGS as far as fixed overhead is concerned is less than the amount expensed in variable costing. In variable costing, yung buong 400,000 sa variable costing in-expense na. Dito sa absorption costing, hindi pa yan in-expense. Naipon muna sa inventory. So this is the reason why the absorption costing income shows lower expenses and therefore greater operating income. The reverse happened in year 3. More units were sold than produced. So in year 3, the fixed overhead expense in COGS is greater than 400K under absorption costing. Under variable costing in year 3, yung buong 400,000 lang yung na-expense kung anong na-incur that year. Dito sa absorption costing kasi, may mga fixed overhead na galing year 2 na nito pa lang na expense, no? Sa year 3. Ayan. And then para i-reconcile, ayan pa rin, no? Production units minus sales units times the FOH rate. And then PS, I love you. Okay? PS, I love you. Yun lang yung pang-reconcile ng absorption costing at variable costing income. Okay? So that is it for this problem. I hope you're able to answer it at this point. Now, let us proceed to the next problem. I want you to read this first. No? This would be our last problem for this topic. So in this problem, your expected production is based on normal capacity, but your actual production under scenario A and scenario B are different from the expectation. So what would happen in this case? There will be a volume variance. I'll give you a few minutes to read and absorb this case. Okay, so the following information pertains to Assis Corporation. So for Assis Corporation, we have the product's sales price of 200, the variable production cost, which is already inclusive of DMDL and VOH, the three, is a total of 120. Fixed production overhead is 20. Variable expense per unit is 10. Fixed expense per unit is 5. Kakaiba, no? Bakit ginawang per unit yung fixed expense? Expense to, selling and admin to. You have a beginning inventory of 4,000 units. Normal capacity is 20,000 units. Okay. Now, you have to remember that under normal costing, pag silent yung problem, naka-normal costing tayo. The predetermined overhead rate is set before the actual production. Bago pa magkaroon ng production, yung predetermined overhead rate, ginagawa na natin. Now, what is our best guess as to what's the expected production? Pag walang binigay na planned or expected production, we can say it is based on normal capacity. Ulitin ko ha. Yung gagamitin natin kasi dapat budgeted or expected, no? Yung planado, the planned one, budgeted or expected production. If there is no budgeted or expected production, our best guess is that we will use the normal capacity. Okay? So, wala pa yung production, kailangan na natin mag-allocate ng overhead. In the case of fixed overhead, no? Fixed manufacturing overhead or fixed overhead, we know that this is 20 pesos. No? In the case of fixed overhead, we know it's 20 pesos. When did we develop this? Before the actual production commence. So, ang FOH per unit natin ay 20. Saan natin dinivide yung total FOH para makuha yung 20? The answer is 20,000, which is your normal capacity. No? Yung normal capacity na 20,000, dyan naka-base, no? Dyan naka-base yung pag-calculate ng FOH rate. So yung question, magkano yung binudget natin na fixed overhead? Magkano yung binudget natin na fixed overhead? Ang kailangan natin gawin, i-work back lang natin. 20,000 times 20, the answer is 400,000. Okay? The answer is 400,000. Let me repeat. We develop the predetermined overhead rate from the word predetermined before actual production. So if our normal capacity is 20,000 units, no? And we are able to arrive at 20, so 20,000 times 20, you have 400,000 as your budgeted fixed overhead. Problem is silent. When the problem is silent, whatever the budgeted FOH is, that is the actual FOH. Ulitin ko, wala naman sinasabi yung problem. So kung walang sinasabi yung problem, kung ano yung budgeted fixed overhead, yan na yung actual. Ito yung problem sa normal costing. Whenever we produce, that's the basis for allocating FOH, no? Sasabihin na natin yung basis ng pag-allocate ng FOH ay production. E di produce natin sa scenario A, 21,000. Mag-a-apply tayo ng 20 times 21,000. Masosobrahan tayo ng pag-apply. Sa scenario boy, produce natin 18,000 lang. So, 18,000 times 20, yun lang yung i-apply. So, magkakaroon tayo ngayon ng variance. Okay? Under each scenario, compute for the volume variance and prepare a profit or loss statements under both full costing and direct costing. By the way, full costing is just another word for absorption costing. And then direct costing is just another word for variable costing. I hope that one is clear. So I'm going to calculate the volume variance for scenario A, and then you will do it on your own for scenario B. Scenario A, what is the budgeted fixed overhead? As I have told you, we can work our way back to the budgeted FOH. We're able to arrive at 20 pesos per unit FOH rate and a 20,000 normal capacity. Yan yung nasa budget. So the budgeted fixed overhead is 20,000 times 20, working back, 400,000 yung binudget natin. Now, if the problem is silent, your budgeted FOH is also your actual FOH. No? If there's no given actual FOH, your budgeted FOH is just the same as your actual FOH. Now, how much have we applied in production? If we produce 21,000 in scenario A and the FOH rate is 20, we were able to apply 20 times 21,000, a total of 420,000. This means that we over-applied the fixed overhead by 20,000 pesos. So the answer is 20,000 pesos over-applied. Okay? The answer is for letter A, what is the volume variance? 20,000 over-applied. That is the answer for letter A. I'll give you a few seconds or even a few minutes to answer letter B. What is the volume variance under letter B? Okay? Bigyan ko kayo ng ilang minutes, ha? Okay. What is the volume variance under letter B? Where production is 18,000 units. Okay. So if you haven't calculated yet, just click the pause button. Okay. Make sure you try before you continue. In scenario B, the budgeted FOH is still the same, 400,000. Again, the fact that normal capacity is our only basis for planned production here, 20,000, and we arrive at 20 per unit. So it follows that 400,000 must be the budgeted FOH. Again, when the problem is silent, your budgeted FOH is also your applied FOH. Mali, ha? Erase. Your budgeted FOH is also your actual. Your budgeted FOH is also your actual FOH. Now, in scenario B, you only produce 18,000 units. So you applied 20 times 18,000, only 360,000. This would result to a 40,000 under-applied volume variance. Okay? 40,000 under-applied volume variance. Okay. Anong gagawin natin sa mga volume variance na to? Ipapang-adjust natin ito sa cost of goods sold. In scenario A, nasobrahan yung pag-apply, bawasan yung cost of goods sold. In scenario, boy, kulang yung pag-apply, idadagdag yan sa cost of goods sold. Okay? Now, will volume variance affect both absorption and variable costing? The answer is no. Volume variance is only applicable to absorption costing. Bakit? Sa variable costing kasi, yung fixed overhead, hindi naman natin ina-allocate sa inventory. Ulitin ko, sa variable costing naman kasi, yung fixed overhead, hindi natin ina-allocate sa inventory. No? Okay, so relevant concept lang yung volume variance dito sa absorption costing. Sa variable costing, wala siyang kinalaman. Okay? So, I want you to prepare the absorption costing or full costing income statement first for letter A, to be followed by the variable costing or direct costing also for letter A. Focus muna tayo kay letter A, ha? Anong gagawin niyo sa volume variance? Ipapang-adjust nyo sa cost of goods sold. Okay? Prepare absorption costing income statement and variable costing income statement for letter A. Assumption A. Okay, game. So we are now going to prepare the absorption costing income statement for item letter A. Okay. Sales revenue is 200 multiplied by sales units of 22,000. Price of 200, sales units 22,000. 200 times 22,000 is 4.4 million. The cost of goods sold would include both variable and fixed production cost. So 120 plus 20 is 140. 140 times 22,000 is 3,080,000. No? 140 times 22,000 is 3,080,000. But because we over-applied our overhead, we offset 20,000, the volume variance from it. So the adjusted cost of goods sold is only 3,060,000. Yung 3,080,000, meron niyang nasobrahan na overhead, no? Nasobrahan na fixed overhead sa pagka-apply. 20,000 yung volume variance, diba? Nasobrahan. So bawasan natin yung 20,000 sa 3,080,000. Meron kang 3,060,000. This would lead to a gross profit of 1,340,000. Again, the gross profit is 1,340,000. Now we are going to deduct the variable selling. The variable selling expense is 10 per unit. 22,000 units sold. So 10 times 22,000 is 220,000. Then finally, the fixed admin. Yung fixed admin, dapat lagi yan nakatotal. Ang weird lang na yung fixed expense, no? Naka-base daw sa normal capacity. So, blank divided by 20,000 is 5. So, ganun din, work back, no? So, at least sinabi naman na malinaw kung saan galing yung 5 per unit. Kung tutusin, hindi dapat ginagawang per unit yung fixed expense, diba? Anyway, working back 5 times 20,000, that's 100,000. So, gross profit of 1,340,000 minus 220,000 variable selling expenses minus 100,000 fixed admin expenses. Operating profit is 1,020,000. Okay? Paano naman sa variable costing? Under variable costing, the sales revenue is the same. 220 pesos 200 pesos multiplied by 22,000 pesos. 200 yung price times 22,000, 4.4 million. In variable costing, we deduct all variable costs first, which includes the variable COGS, 120. Tama? 120 yun. Okay. 120. And then the variable expense of 10. So variable COGS is 120 times 22,000. Variable selling and admin is 10 times 22,000. So minus 2,640 minus 220,000. This would give you a contribution margin of 1,540,000. Next things to be deducted are the overall fixed MOH, which is 400,000, yung actual, and the fixed selling and admin, which we calculated to be 100,000. So whatever was incurred as fixed MOH during the year, it will be expensed in its entirety. 1,540,000 minus 400,000. Pag silent, yung actual FOH tsaka yung budgeted FOH parehas, ha? So 400,000 yung actual din. Fixed admin 100,000. So this would give you 1,040,000. Okay? If you would notice, the difference between absorption costing income and variable costing income is 20,000. Wala tong kinalaman sa volume variance, ha? Nagkataon lang na 20,000 din yung volume variance. To arrive at 20,000, you should do production units minus sales units times the FOH rate, no? Times the FOH rate. FOH per unit. So, doon ang galing yung 20,000. The production units is 21,000. Sales is 22,000. So, that's 1,000. 1,000 times the FOH rate of 20 is 20,000. PS, I love you. Production is less than sales. Absorption income is less than the variable income. So that's the explanation of the difference, ha? Walang kinalaman yung volume variance sa difference na yan. Anyway, let us now answer. Scenario boy. Prepare the full costing income statement and direct costing income statement under scenario boy. Sales of 15,000 units, production of 18,000 units. Okay, so let us now continue, this time under scenario boy. For this one, I really want you to do this by yourself first before listening to me explain the solution. Please, ha? Please pause this video. Okay, please pause this video. In the event that you haven't answered yet, please really pause this video. And then, gawin nyo muna. No? Gawin nyo muna yung scenario B. Kasi sinample ko na yung scenario A, no? Kung hindi nyo alam, okay lang. But here in scenario B, please do it by yourself first. Especially the absorption costing income statement. So under scenario B, the sales is only 15,000 units. Production is 18,000 units. Okay na? Based on our calculations, the volume variance is 40,000 under applied. Okay? 40,000 under applied. So let's now answer. For absorption costing, the sales revenue must be 3 million. No, 3 million. Paano nakuha? 200 to, no? 200 times 15K is 3 million. 200 times 15K is 3 million. Now, we're going to calculate for the cost of goods sold, which is a total of 140. Remember, 120 yung production cost, 20 yung fixed overhead. 140 times 15K, 2.1 million. The cost of goods sold unadjusted, no adjustments yet, ha? Unadjusted is 2.1 million. But because we under-applied by 40K, we're going to add 40K to the cost of goods sold. Under-applied, no? Ibig sabihin kulang ng 40K yung pag-apply ng fixed overhead, dadagdagan natin ngayon. So the adjusted cost of goods sold is 2,140,000. Again, the adjusted cost of goods sold is 2,140,000. Sales revenue is 3 million. Cost of goods sold unadjusted 2.1 million. Cost of goods sold adjusted 2,140,000. Okay? I hope that one is clear. So we now have a gross profit of 860,000. So we will deduct next the variable selling expense, 10 per unit. No? So 15,000 units lang nabenta sa scenario B. Ha? In scenario B, our units sold is only 15,000. Our units sold is only 15,000. So what are we going to do? 10 times 15,000, you have negative 150. Minus, no? Minus kasi to. 10 times 15,000 is 150K. Walang problema sa fixed admin expense. Pardon me. Walang problema sa fixed admin expenses. It's still 100,000. Remember, yung 5 per unit, naka-base na yun sa normal capacity. Technically speaking, mali yun. Pag fixed admin, hindi talaga dapat ina-allocate. Pero kung yung fixed expense mo, ina-allocate mo, no? Dapat may clear basis. Based daw sa normal capacity. So, i-work back lang natin sa budgeted fixed admin expense. So, 5 times 20K, 100,000. Kung ano yung budget, yun din yung actual pag silent, no? So, what's your absorption costing operating profit? It would be 860K minus 150K minus 100,000. That would be 610,000 pesos. That's your operating profit for scenario B under absorption costing. Again, that's 610,000 pesos. I hope that one is clear. Okay? I'll give you a few minutes for variable costing. Okay. Game? Okay, game tayo, ha? So this time, we're going to do variable costing under scenario B. Again, just a quick reminder. When it comes to variable costing, the concept of volume variance is irrelevant. Walang volume variance pagdating sa variable costing. Okay. So again, sa absorption costing, ang nakuha nating operating profit, 610, no? 610,000. Paano naman dito sa variable costing? Sales revenue. Sales revenue is the same. 15,000 units sold times 200, that's 3 million pesos. Instead of deducting cost of goods sold to arrive at the gross profit, we would deduct all the variable expenses. Variable cost of goods sold, 120 lang yan, no? 120 times 15K is 1.8 million. No? Again, that's 120. No? 120 times 15,000 is 1.8 million. Variable selling expenses, that would be 10 pesos. 10 times 15,000 is 150,000. Yun yung variable selling expenses. And then you have a gross profit of, gross profit tayo. Nagkamali ko. When you deduct the variable cost from sales, this would give you your contribution margin. No? This would give you your contribution margin, which is 1,050,000. No? Contribution margin yung tawag dyan. Again, walang kinalaman yung volume variance kay variable costing. The next things to be deducted are the fixed expenses. As calculated, the fixed manuf overhead must be based on normal capacity, 400K. Fixed admin expenses also based on normal capacity, 100,000. Operating profit is 550,000 under variable costing. No? Under variable costing. So there you go. So if you're going to notice, magkaiba naman syempre, no? Yung profit ng absorption tsaka variable costing because production and sales are different. But this time, production of 18,000 is greater than the sales of only 15,000 units. So what does this mean? Mas malaki yung production kaysa sa sales. I is greater than love you. Absorption income is greater than variable income. And there you go. Magkano pala yung difference? The difference is 60,000. Bakit yan 60,000? Siyempre yung production ay, ano yung production nito? Production is 18K. Sales is 15K. So the sales units is 15. 3,000 difference times the FOH per unit of 20. Tama naman, no? Okay, 20. So, 3,000. The difference between production and sales under scenario boy, production and sales is 18 minus 15, 3,000. 3,000 times 20, 60,000 yung difference. Okay, again, absorption income is greater than variable income due to the fact that production is greater than sales. Okay? P.S. I love you. Ayun. Okay? So that would be it for this problem. This will be the last topic before quiz 1. Okay, I'm talking here to batch 2024, no? I'm talking here to batch 2024. Okay. This would be the cutoff, no? This would be the cutoff for quiz 1. Hanggang dito lang tayo, ha? Hanggang dito lang tayo sa quiz 1. Anything discussed next week will form part of quiz 2. Okay? Anything to be discussed after this lecture will form part of quiz 2. Okay, do you have any short reminders? Yun lang naman, no? Coverage lang. Okay, I think that would be it. So, I'm following the convention of SIPALE, MAS, 70 items, ha? 70 items yung MAS sa Sipale, all of which are multiple choice questions. So that would be your quiz 1. Anyway, I'm already with you. I was already with you last time. So you already know the nature of the examination. Okay, gusto ko. I'm tempted to say, are there any questions? Of course, how would I know if there are any questions? Because we are recording online. Okay? Okay, just give me a few minutes. No? Baka may nakakalimutan ako. Okay. So, the coverage of the examination, pabanggitin ko na lang ha. The coverage of the examination would be number 1, introduction to management accounting. So we have discussed from the functions of management until staff and line positions, and then the recent trends in management accounting, those concepts like Kaizen. To be followed by cost behavior, we will utilize both high-low method and least squares regression, right? Okay. High-low method kasama, least squares regression kasama. And then CVP analysis. We also had a recorded lecture last week, no? CVP analysis. Nakarami tayo ng recorded lecture. Umpisa pa lang ng SEM, no? CVP analysis, break-even point, margin of safety, difference point, etc. Then lastly, ito na, no? Variable versus absorption costing. Okay? Variable versus absorption costing. Okay? So, that's it for tonight. Thank you for listening, if ever you're listening, and good luck with your examination.